Mastering options. Trading basics begins with unlearning the fantasy that options are shortcuts to fast wealth, because options are not lottery tickets. They are contracts about uncertainty. And if you don't understand what kind of uncertainty you are trading, they will punish you faster and more efficiently than almost any other instrument in the market. I learned this lesson the hard way. When I first encountered options, I was seduced by leverage. Small capital controlling large positions, big percentage gains defined risk. What I didn't understand then was that options magnify time behavior and mistakes, and unless you respect those forces deeply, the math will turn against you long before you feel like you did anything wrong. At the most basic level, an option is a right, not an obligation. A call option gives you the right to buy an asset at a fixed price within a specific time. A put option gives you the right to sell an asset at a fixed price within a specific time. That sounds simple, and mechanically it is, but psychologically it is not. The moment you buy an option, you are making 3 bets at once: direction, time, and speed. Beginners usually focus only on direction. They think I'm bullish, so I buy calls, or I'm bearish, so I buy puts. That narrow focus is where most early losses come from. Direction is only one dimension. Time is the second, and it is ruthless. Options decay. Every day that passes without the move you need reduces the value of your option. This is called time decay, and it works silently in the background. You can be right about direction and still lose money because you were wrong about when. This was one of the most painful lessons for me early on. Watching a stock move slowly in the right direction while my option lost value taught me that options are not just about being right. They are about being right fast enough. That constraint changes everything. The third dimension is volatility, and this is where options stop behaving intuitively. Option prices are heavily influenced by expected future volatility. When fear is high, options become expensive. When calm returns, options get cheaper, sometimes even if price moves in your favor. This is why beginners often lose money buying options around earnings or news events. They pay inflated premiums, and once the event passes, volatility collapses and crushes option value. The stock can move in the expected direction, and the option can still lose money. This feels unfair until you realize you were not just trading price, you were trading expectations about uncertainty. Understanding calls and puts mechanically is necessary, but insufficient. What matters is how you use them. Buying calls and puts is the simplest strategy, and also the most abused. Long options offer limited risk and unlimited or large reward, which is why they are attractive. But they come with a low probability of success if used casually. Time decay and volatility work against you. If you buy options without a clear catalyst time frame and exit plan, you are essentially paying rent on hope. This is why many experienced traders eventually shift from buying options to selling them, or at least using strategies that benefit from time decay rather than fighting it. Selling options flips the equation. Time works for you instead of against you. But selling options introduces a different kind of risk assignment, risk margin requirements, and potentially large losses if unmanaged. Options do not remove risk, they reshape it. Beginners who rush into selling options without understanding this often trade one problem for another. One of the most important distinctions I learned is that options are not best thought of as directional bets, but as risk tools. A call can be used to express bullishness with defined risk. A put can be used as insurance against downside. Spreads can define risk and cost. Covered calls can generate income while capping upside. Protective puts can stabilize portfolios during uncertainty. When options are used this way, they become instruments of control rather than instruments of speculation. As a beginner, the biggest danger is trying to learn all strategies at once. Iron condors, butterflies, calendars, diagonals. These sound sophisticated, but sophistication without understanding is fragility. The market does not reward complexity, it rewards clarity. The traders who survive options long-term are not the ones who know the most strategies, but the ones who know why they are using a specific one in a specific environment. Another hard truth is that options magnify psychology. Losses can happen faster. Wins can feel intoxicating. Because options often expire, worthless beginners become desensitized to small losses and then shocked by a larger one. This trains bad habits. I had to learn that position sizing in options must be far more conservative than in stocks. Small bets, repeatable process, and strict rules are not optional. Here, they are survival requirements. Over time, I realized that options trading is not a separate skill. From trading or investing, it is a layer on top of them. If you do not understand trend range volatility and your own behavior in the underlying asset options, will not fix that. They will expose it. Options reward those who already have discipline and punish those who are still searching for shortcuts. And this is where we need to continue next, because understanding what calls and puts are is only the entry point. The real value comes from knowing when to use options, which basic strategies make sense for beginners, and how to structure risk so that time and volatility do not quietly erode your account. And that transition from definitions into practical usage is exactly where we go next, as we move from explaining options conceptually into laying out a beginner-friendly framework for using calls, puts, and a small number of simple strategies in a way that prioritizes capital protection and learning rather than excitement and leverage. And that continuation begins right here as we step into the practical side of options, trading basics in the next part, by narrowing your focus to a small set of option uses that solve real problems instead of chasing payoff diagrams that look impressive but behave unpredictably under pressure. Because options become dangerous the moment you use them without a clear reason tied to market conditions and your own limitations. The first principle I wish I had followed earlier is this. As a beginner, options should reduce risk or structure risk, not multiply it. If a strategy makes you feel excited, rushed, or clever, it is probably the wrong one to start with. The most beginner-appropriate use of options is defined risk directional expression, and that usually means simple call or put spreads, not naked calls or puts. A vertical spread, buying one option and selling another further out, immediately solves two problems that destroy beginners: excessive premium cost and uncontrolled time decay. By selling the second option, you reduce how much time works against you and cap both risk and reward clearly. This is not a limitation, it is clarity. When you know exactly how much you can lose and exactly how much you can make, emotional negotiation drops dramatically. You stop hoping and start executing. If you are bullish, a bull call spread allows you to express that view without needing a violent move. If you are bearish, a bear put spread does the same. These strategies are not about hitting home runs, they are about aligning with probable moves. Beginners lose money buying far out of the money options because they are cheap and exciting. Professionals make money with options by accepting smaller, more realistic payoffs with much higher probabilities. That mindset shift is everything. Another foundational strategy is the covered call, which is often misunderstood as an income trick rather than a behavioral tool. When you own a stock, you are willing to hold selling a call against it forces discipline. It caps upside, yes, but it also forces you to define what enough looks like. It pays you for time passing instead of punishing you for it. For beginners who struggle with holding positions, calmly covered calls can be a bridge between stock ownership and options literacy, because they introduce option mechanics without exposing you to naked risk. Protective puts are the opposite side of that coin, and one of the most underused beginner tools. Buying a put against a long stock position is insurance. You pay a premium to define disaster. Most beginners resist this because it feels like giving up profit. What they don't realize is that defined downside often improves behavior. When you know the worst case, you stop reacting emotionally to normal volatility. Options used as insurance are rarely about maximizing returns. They are about protecting decision quality. One of the most important rules I follow and insist beginners adopt is matching option duration to the thesis. If your idea is based on a multi-week or multi-month view, buying options that expire in days is self-sabotage. Short-dated options require precision and speed. Longer-dated options cost more, but they buy you time, and time is what most beginners actually need. Being early with options feels the same as being wrong, and without time, the market never gives you a chance to be proven right. Position sizing in options must be dramatically smaller than in stocks. This cannot be overstated. Because options can go to zero, you must size them as if that outcome is normal, not exceptional. If a full loss would trigger frustration, revenge trading, or rule breaking, the position is too large. Most long-term option traders survive not by winning big, but by losing small, and often enough that losses stop being emotionally significant. Another habit that saved me was deciding before entering an option trade whether I am managing it by price time or volatility. Am I exiting if the underlying hits a level? Am I exiting after a certain number of days regardless of price? Am I exiting if implied volatility collapses? If you don't decide this in advance, you will invent rules mid-trade under emotional pressure, and options punish improvisation far faster than stocks ever will. The final discipline is knowing when not to use options at all. Options are terrible tools in low volatility, low clarity environments, unless you are selling them with experience. They are also dangerous around events if you do not understand volatility pricing. Sometimes the correct strategy is owning the stock or doing nothing. Options are not required to be active in markets. They are optional, and treating them as optional is how you survive them. What I want you to carry forward is this: options do not reward curiosity, they reward restraint. They are not about learning many strategies, but about learning one or two uses deeply and applying them only when conditions and psychology align. When used this way, options stop feeling like gambling instruments and start feeling like precision tools layered on top of sound market understanding. And that is the real foundation of mastering options basics. If this perspective helped ground your understanding of calls, puts, and simple strategies, I invite you to subscribe to the channel so you can keep building skill without blowing up tuition, and leave a comment sharing which options use makes the most sense for you. Right now, directional spreads, covered calls, protection, or staying away entirely. Because honest self-assessment is the first and most important strategy in options trading, and it is the one that will keep you alive long enough to learn the rest.